Market PMI data is anything to go by. Kenya's economy is slowing down in the second half of 2018, and that's after a strong first half of the year where we saw GDP growth average about 6%. At 52.7, the PMI reading in September was the lowest in 10 months, and the next 2 months didn't fare any better, with readings of 54 in October and 53.1 in November, both in weaker than average territory. Now, what is of more concern, though, is the country's public debt, which was over about $50.6 billion by the end of September. And the authorities' response to this hydra of a problem they created. Of course, Kenya has an $8.6 billion of debt payments to make this year, at least half of which is foreign. That includes a $750 million Eurobond payment, which is due at the end of June. While CGTN's Ramah Nyang spoke to the Standard Bank economist for East Africa, Jibran Qureishi, he started their conversation by asking him if raising taxes, as the Kenyan government has done, was the right solution to the country's debt problem.
There's always a delayed trickle-down effect between so-called infrastructure spending and the benefit on the ground. But if we haven't seen that in the past 5 years, I think it's important for the government to really realign its priorities before we start seeing more taxes that will only make the situation worse on the ground.
Yeah, I should point out for the benefit of our viewers that between 2013 to September this year, we actually went up in terms of public debt by about $30 billion or so. And we have debt payments this year alone, this fiscal year, of about $8.7 billion. Half of that is foreign. We have to go back to the market at some point in the first quarter of 2019 to refinance the foreign portion of that debt, don't we?
So we've got two big ones coming up. We've got a $760 million syndicated loan maturing in March, and then we've got the
That's the one that we kicked forward from, what is it, 2 years ago?
The rollover, yes.
Right.
And then we have the 5-year 2014 Eurobond that's maturing in June. So roughly we need about $1.6 billion for refinancing. But if you look at the budget document, they're looking for a total of roughly about $2.9 billion. So
there might be some extra borrowing of what, 1.5, give or take?
Yes, new money is going to be 1.5. So that's how much our debt to GDP is going to grow by. But you know, I think a lot of people have suggested that we're not going to refinance it because our debt position has become quite precarious. But we have to go back to the market.
We don't have options, do we?
We don't have an option. And we're not going to grow out of it, and we can't pay from reserves.
There was a question that, or rather proposal that the finance minister was bandying about, saying that he would like to issue, following India's example with masala bonds, saying he would like to issue Kenya shilling denominated bonds, but in an offshore market like Ireland, for instance. Is that even viable, though? How much shilling liquidity is floating outside this economy?
I heard that as well. I mean, I don't know how they're going to execute it. I'm not sure about the specifics and how it's really going to work. You know, how the foreign exchange flow is going to work, if there is one at all, even if it's a diaspora bond. But I think, I still believe we have to borrow. Can we delay our borrowing? Of course not, because as you probably know, there's a growing consensus that if not the end of 2019, then early 2020, we are going to see a very, very significant slowdown in advanced economies, where 9 out of 10 economists are saying there could be a recession in the US. So a lot of African sovereigns are now saying, you know, whether it's a masala bond, whether it's a
safari bond, or
whatever they call it, we have to go to the market, and we have to go to the market before there's this slowdown.
Given where our debt position is, our debt costs this year, because $8.7 billion relative to our tax revenue base of what, $14–15 billion, you're really, really in a tight position. Either way, anyone who's lending to Kenya will demand a steep premium, won't they?
Agreed. And I think it's paramount for authorities to get the blessing of the IMF, if I could call it that, before they especially look to refinance a Eurobond. As we speak, you know, you've got Kenya's 30-year Eurobond trading north of 9%. The yield is higher than one-trick pony Angola. And, you know, some investors might think it's cheap, but of course, it just shows you the reflection of how Kenya's credit risk has deteriorated because of its fiscal metrics, but also because of losing the IMF's faith. Right. Now, important question is, if the IMF is in talks with authorities to get a new program, whether it's a standby arrangement or any other program, what are the preconditions going to be? Is it going to be the rate cap as well, being repealed or substantially amended? Can National Assembly, you know, throw us a lifeline with that? And will the IMF be lenient and say, you know, if you perform on the fiscal side, will overlook the rate cap story.
With the last program that we had with the IMF, for the standby facility, we didn't meet the metrics, the performance metrics that we agreed to. From the fund's perspective, why should they trust us again?
And that's a very good question. I don't have the answer to that, but the fund may come back with slightly different performance criteria, in my view. I think the fund will, in my personal view, I think the fund will explicitly, really relentlessly focus on Kenya's fiscal metrics. They'll ask them to improve credibility of revenue estimates, I think. On the rate cap side, the fund would love the CBR to be delinked from the rate cap, and they'd love the 400 basis point spread to be increased. But I think there will be, in my personal view, an element of leniency from the fund towards authorities when it comes to the rate cap.